Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sun Hung Kai Properties Limited interim report. Sun Hung Kai Properties Limited offers a diverse range of businesses and services across various sectors. The company's primary focus lies in property development and investment, encompassing residential estates, offices, shopping malls, hotels, and service suites for sale and rent in Hong Kong, mainland China, and internationally. In addition to property development, the company provides a wide array of services including property management, construction-related services such as landscaping and electrical installation, insurance products, and public transportation services. It also offers data center facilities, value-added services, general insurance, airport freight forwarding services, and Internet of Things (IoT) solutions. Furthermore, Sun Hung Kai Properties Limited engages in various other businesses including mobile telephone system operation, asset management, loan financing, fire prevention services, architectural engineering, property and facility management, business aviation center services, real estate agency, secretarial services, and manufacturing of ready-mixed and precast concrete. The company also operates hotels and provides mortgage services, making it a comprehensive player in the industry. Overall, Sun Hung Kai Properties Limited's extensive portfolio reflects its commitment to diversification and expansion into various sectors, positioning itself as a leading player in the real estate and service industries. Sun Hung Kai Properties Limited market capitalization of $384 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Sun Hung Kai Properties Limited holds a significant advantage in their industry. Sun Hung Kai Properties Limited trades at a lower price-to-earnings ratio of 17 times and a higher price-to-book ratio of 0.62 times relative within the industry. This suggests a potential market detachment, as Sun Hung Kai Properties Limited trades at discounted levels, while the broader industry remains fairly valued, warranting deeper fundamental analysis. The balance sheet appears very conservative, with liabilities representing only 25% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 2.85%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth and decline can be identified through a review of various factors. On the growth side, several key contributors stand out. Firstly, the group's revenue saw a significant increase of 32% year-over-year, YoY, driven by various factors including a substantial rise in development profit to HK$4,885 million from HK$1,506 million. Additionally, the introduction of trendy offerings and experiences in malls, as well as the completion of 3 ITC in Shanghai, contributed to revenue growth. Another significant driver was the strong market response to the Sai Sha project, which led to increased transaction volumes in Hong Kong's primary residential market. The reduced value-added tax on short-held home transactions by the central government also had a positive impact on revenue. Furthermore, the completion of properties in the retail portfolio and robust IPO-related activities further boosted revenue. On the decline side, several factors contributed to the decrease in revenue. Firstly, net rental income declined by 0.6%, while property rental revenue decreased by 36.5% in the mainland. Hotel operations revenue also saw a decline of 11.5%. Additionally, impairment provisions for development properties and a decrease in other revenue from services rendered by the group to associates further contributed to the decline. The data suggests that revenue growth was driven primarily by factors such as increased transaction volumes, strong market response to specific projects, and government policies. Conversely, revenue decline was largely due to declines in rental income, hotel operations, and impairment provisions for development properties. The net income and profit margins of a company underwent significant changes over time. Initially, there was a substantial increase in net income from $1,872 million to $7,841 million, representing a 303% growth. This trend continued with a further increase of 34.6% from $7,841 million to $10,585 million. In terms of profit margins, the operating profit margin improved by 4.8%, while the net finance costs margin decreased by 5.9%. The profit before taxation margin saw a notable increase of 40.7%. However, there were also instances where profit margins declined. For instance, the consolidated profit margins dropped to 17.5% in one period. Additionally, property development profit margins experienced a decrease, with an average profit margin dropping to 8%. The gain on land resumption decreased by 65.3%, and the profit on sale of investment properties decreased by 27.4%. The reasons behind these changes are not explicitly stated in most cases, but may be attributed to various factors such as changes in market conditions, operational efficiency improvements, or strategic decisions made by the company. Specific reasons mentioned include a gain from land resumption by the government and reported profit on sale of investment properties. The company's financial performance indicates a positive trend in its operating cash flow. According to the provided data, net cash from operating activities has increased from $14,345 in 2024 to $21,756 in 2025. Similarly, cash generated from operations has also seen an upward movement, rising from $19,041 in 2024 to $24,225 in 2025. These figures suggest that the company is efficiently managing its resources and generating sufficient cash flow from its core business activities. The company's debt level and interest expenses have undergone significant changes. In terms of debt level, the long-term borrowings decreased by $9,661 million, resulting in a total decrease of 6% from $110.2 billion to $103.2 billion. This reduction indicates that the company has successfully managed its debt obligations. The interest expenses have also seen a notable decline. According to the financial reports, the net change in interest expenses is plus 895 million HKD, indicating a significant decrease from $527 million to $1,632 million. Furthermore, another report shows a similar trend, with interest expenses decreasing from $578 million to $658 million. These changes suggest that the company has made efforts to reduce its financial burden and optimize its operations. The financial performance of various segments and regions has been mixed, reflecting the complexities of the market. On the positive side, Hong Kong has emerged as a standout performer, with significant increases in revenue and growth across multiple sectors. The Asia-Pacific region also showed strong performance, driven by China's robust economy. In contrast, certain segments have struggled to keep pace. Transport infrastructure and logistics, hotel operations, and recurring income have all underperformed, contributing to overall decline in these areas. Additionally, the Hong Kong retail portfolio and mainland office portfolio have experienced setbacks, while Route 3 operations have also faced challenges. However, there are bright spots within specific industries. The retail industry has shown resilience, with strong demand for office leasing market and loyalty program offerings. Real estate development and renewable energy have also performed well, driven by growing demand for sustainable solutions. Property development in both Hong Kong and the mainland has been successful, while data center operations and telecommunications have also seen growth. Geographically, Hong Kong's performance has been a highlight, with significant revenue increases from the previous year. In contrast, the mainland region has experienced a decline in revenue, underscoring regional disparities in market conditions. The company is optimistic about its future prospects, citing its strong position to capitalize on Hong Kong's economic transformation. Management emphasizes the importance of delivering high-quality properties and services that align with the city's integration into national development. This focus on sustainability and community building is expected to drive long-term growth. The company's financial strategy is centered around minimizing refinancing risk through a well-balanced maturity profile of its committed banking facilities. This approach optimizes financing costs and ensures adequate liquidity for funding needs. Additionally, management closely monitors the company's foreign exchange exposure, which is deemed small due to its large asset base and operational cash flow primarily denominated in Hong Kong dollars. Management is confident in the company's long-term prospects, attributing this confidence to its reputable brand, strong financial position, seasoned management, and proven strategies. This confidence is reflected in the company's ability to navigate economic changes and capitalize on opportunities arising from Hong Kong's transformation. The company has a history of paying dividends to its shareholders. According to the financial reports, in both 2024 and 2025, the company paid out $8,114 million in dividends. This indicates that the company has been consistently rewarding its shareholders through dividend payments. Additionally, the final dividend approved and paid during the interim period for 2024 was also $114 million, further solidifying the company's commitment to sharing its profits with its investors. That concludes the financial summary for Sun Hung Kai Properties Limited. Feel free to comment below, and I will be happy to answer them when possible.